And so today we're starting off with working capital. We started looking at the direct method and the indirect method yesterday, and we saw that there was quite a lot more that was involved around our indirect method. One of the aspects for our indirect method that we're going to have to include in our disclosure in terms of the operating activities is around working capital. So our working capital, you're already quite well versed with this from a managerial accounting and finance. You know it's going to include our trade and other receivables, our inventory, as well as our trade payables. So those are the three elements that we're going to be including when providing for our working capital. And we know that trade and other receivables and trade and other payables are probably going to include a bit more than simply debtors and creditors. We need to perhaps include items such as prepaid expenses, income received in advance. So all those types of accruals will also need to be included as part of either trade receivables or trade payables for us to get this difference or movement from opening balance to closing balance. And that is what we're trying to do here, is we're comparing our current year balance with that of the prior year, and we're trying to ascertain, was there in fact an increase in these particular balances or a decrease? Now, what is important is that our assets, our trade receivables and our inventory are going to be moving in the same type of direction. Okay, so they're both assets going to be moving in the same direction, and that is what we're seeing here included in our working capital itself. Let me just see if I can make this a bit bigger for you. Okay, so we expect to see, if we have an increase in trade receivables, we're having more people buying on credit, so it's going to be likely that there's a decrease in cash. They're probably not paying us back as much as we are anticipating. We're having more people buying on credit than those who are actually paying. So in fact, we have an increase in trade receivables. We expect that to correspond to a decrease in cash. So we would find that to be in brackets in our disclosure of our statement of cash flows. Similarly to inventory, for buying more inventory and the inventory balance has increased from last year to this year, we expect there to be a decrease in cash, and that increase in the inventory movement would be in brackets. Now, conversely, trade payables is a liability, so it's going to move in an opposite direction to our trade receivables and our inventory. So where we have an increase in our trade payables, we would find there to be an increase in cash. Okay, so we're buying more on credit. We're kind of keeping our cash to the business itself, not paying them off as quick or as much. And therefore, we would expect to see an increase in cash, and that would not be in brackets. Golden rule in the statement of cash flows is if you're stuck somewhere, you're not sure whether you should be increasing or decreasing or what the movement should be in your statement of cash flow, when in doubt, draw up a ledger account. That's going to be a lot of our go-to. We do include that in our workings as well, for not only your lecture today, but also your tutorials and your assessments. So it's a very useful way to get what is that movement in cash, what is that movement in bank, and you can then proceed from there. Moving on to our investment activities, just a reminder that our investing activities and our financing activities are exactly the same for direct and indirect method. So the only difference between those two methods is in that operating activities section. All the rest remains the same, no matter which method you are applying. Okay, we can also, like we said previously in our lecture yesterday, that you can be asked to just prepare the investing activities or just prepare the financing activities. And already you've noticed from Accounting 1 that your statement of cash flow brings in a wide variety of topics within a single disclosure. So within statement of cash flows, we can test a wide variety of topics, particularly for us in second year. Investing activities, we can deal with all of those items such as your intangible assets, your PPE, those types of movements. And then when we move on to financing, we can look at things like our equity. We can look at financial instruments. All those types of things can be included within our statement of cash flows. So it is quite a nice way for us to test a variety of topics within a single question. With our investing activities, we are really focusing here on the long-term assets. So the non-current assets are generally what you'll be looking at within the investing activities section. You'll quite often find the movements will relate to acquisition and disposal of the assets, so buying and selling. Our cash outflows and inflows must be shown separately. Okay, so they must not be net off from one another. You can't say, well, I purchased machinery and I sold machinery, so I'll just show the net effect. You must show them separately. Replacement of assets and expansion of assets are also separately disclosed. So a lot of emphasis here on showing these figures separately. When we move on to financing activities, these are activities that change the capital structure of the entity. Remember, financing activities are giving us some sort of insight as to how this business is being financed. Is there a heavy reliance on loans and liability? Is there a heavy reliance on equity? Okay, so what is actually being used to invest in this entity? Invest in both the investing activities as well as financing those general operations as well. So as we said, these activities can change the capital structure of the entity, looking at it from both the debt and the equity perspective. And it shows shareholders how much of the operating and investing activities have in fact been funded by equity and debt. And so a lot of information is really included and provided within a single statement, being our statement of cash flows. So we can see the usefulness and reliance that would be placed on this particular part of the financial statements. Having these advantages of objective information, a raw and unfiltered view of the company, less subjective estimates, judgments, potential biases are all removed from our statement of cash flows. So it is considered, especially by management accountants, to be one of the most reliable elements of a set of financial statements because it is the least open to manipulation. It is a very more honest view of the performance of the company. Presenting our statement of cash flows, so looking at a lot of the generic information that would be included, starting off with the company name. So we don't do consolidated statement of cash flows for second year. You're only going to be doing a single entity. So company name, ABC Limited. We want to write statement of cash flows, and similar to the statement of profit or loss, we're going to write for the year ended. Now, I was a bit disappointed coming through from test 2 marking that there's still students losing out on these half marks for headings simply because they're writing for the year ended for a statement of financial position. Okay, a statement of financial position is based on balances, and those balances are updated on an annual basis. Therefore, we use as at. For statement of profit or loss and statement of cash flows, we do use for the year ended. It's for a particular period of time. Okay, starting off with our year at the top of our second column there, include these little things. There are marks allocated to it. I believe in test 2 there were marks allocated as well for having the rand currency shown at the top of that amount column. So little things, very important when you are providing for disclosure, because these are required in terms of the International Financial Reporting Standards. So make sure you get your basics right, get your basic disclosure right, and then you can go through and fill in your figures. It just helps you boost your marks a little bit more, remembering these small things. What we expect to find is our cash flows from operating activities. Here they've given us a figure. Our cash flow from investing activities and our cash flow from financing activities. We then add all these together. So if we take 1,000 minus 2,000 plus 5,000, we are going to get the net cash outflow inflow of 4,000, and that should reconcile to our opening balance and closing balance movement of cash and cash equivalents. So if we see at the bottom of the table there, our opening balance was 1,500. There was a movement up to the closing balance of 5,500. So we can then see there was a positive movement of 4,000, which actually equates back to that calculation for the operating, investing, and financing activities. So we see that these all equal each other. If they don't, we know somewhere along the line something has gone wrong in operating, investing, or financing, and we would need to adjust accordingly. Okay, typically, your cash and cash equivalents are the easy figures to actually ascertain from the question, and you shouldn't have too much difficulty there. So more than likely, something's gone wrong in one of your activity section in the top part of your statement of cash flows. Okay. We're now going to do a bit more of a recap. What work have we covered up to this point? What type of sections have we already looked at from 102? And then progress into some of our accounting 2 topics as well, and how those could be introduced and impact our statement of cash flows. So our working capital changes, we know the focus there is on the current assets and the current liabilities. We're adjusting for trade receivables and trade payables movements. And this adjustment is ultimately going to remove the effect of those that we have sold or purchased to on credit. Whereas our inventory adjustment is going to be based on our inventory purchases as well, or perhaps being sold. As you'll find, your inventory movement for the working capital changes. This is the amount in the profit before tax in relation to inventory, and is only the cost of items that have been sold. Adjusting for inventory will result in all inventory purchase being included, and therefore not just those sold. And we'll see this coming through in our example that we're going to be doing today. It's quite an extensive example 4 from Grip and Gop, where we look at this in a lot more detail and deal with the mechanics of the calculations. Don't forget to adjust for accrual movements. This is quite often where students forget something out. They deal with just the debtors and creditors, and they don't actually look for the adjustment in accruals. So your accrued expenses, income received in advance, etc., those are also form part of our working capital and must be adjusted in the same manner that you have done for your debtors and your creditors. Now, you'll find example 1 to 3 in your textbook. They're quite simple. That is why our main focus today is going to be looking at example 4, where we have quite a bit of detail, and we'll be going through the more difficult aspects of a statement of cash flows. Looking at some of our accounting 211 sections, so that is why it is so vitally important that you pass 211 to progress to 212, because there is going to be a lot of those sections included, as you've seen in IS 8, again, pulling through to statement of cash flows. So IS 1, we know, of course, it is only one of 5 items to form a complete set of financial statements. Inventory, we might need to consider inventory write-downs, potential reversals of those write-downs, any under or over absorption of fixed manufacturing costs. Now, where do you think inventory is going to impact our statement of cash flows? Which activity section?
Purchasing and selling.
Purchasing and selling. And which part of our statement of cash flows is that? Is it operating, investing, or financing?
Operating.
Very good. So that would impact our operating activity section. And that is what we're going to be looking at today as well, when we will do the calculations of that. Tax. Okay, we always hope to see ignore tax when we get a more integrated type question. Yeah, but we do need to be mindful. Quite often they do include tax in statement of cash flows, but it's not like you've made adjustments and you need to do some heavy calculations in tax. So it's quite basic, more along the lines of you've paid provisional tax, this is how much was owing, this was your statement for the current year, and you can work out what the bank figure is. So it's not super intense within the aspect of your statement of cash flows. So nothing to be scared of. I don't want you to be scared of tax or think, oh no, this is going to be just an absolute mess. It's just a small section of your statement of cash flows. It's just a small aspect of it. And we expect you to draw up just this little T account as part of your workings to determine what the change was in bank. And we know already that tax is made up of both current and deferred tax. Payments and receipts in respect of current tax go to current tax payable. So you'll quite often find that in a trial balance, you'll be given a current tax payable value as of the previous year, and you can use that to insert it into your T accounts and move forward from there. We know that our deferred tax is an accounting adjustment, so no cash is changing hands here. So we don't expect with deferred tax to see anything coming through in our statement of cash flows. It is simply an accounting adjustment, and it's not going to result in any sort of bank. If you think of deferred tax in terms of your journal entries or your T accounts, do you ever see debit deferred tax credit bank or vice versa? Okay, there's never going to be a situation where deferred tax is going to impact bank. So it's not going to be important to us for the purposes of cash flow statements. Deferred tax could be processed through profit or loss as well as OCR. We know those items are generally shown net of tax. And thinking about tax itself, where will we find it in our statement of cash flows? Where will we find this tax paid or tax received in our statement of cash flows?
I could be mistaken, but isn't it operating activities as well?
Yes, it is operating activities. So we do have a little section at the top for operating activities to get to our cash from operations. And just under cash from operations, we'll have our tax paid, we'll have interest paid or received, and dividends paid or received. So very good. It would form part of our operating activities. The next section we're going to consider is PPE. And right off the bat, we've been talking about this quite a bit as we went through the different activity sections yesterday. And we said PPE being a non-current asset, which section do we expect to find our PPE in the statements of cash flows?
Investing.
Very good. It will be part of our investing as a non-current long-term asset. That is where we expect to see it coming through. And it's going to be a little bit different to what you might see in your statement of financial position or your statement of profit or loss, because here we are focused on the cash flow. So we're talking about purchases of the inventory and sales of the inventory. And again, furthermore, when we're talking about sales, we're not talking about the profit or loss on the sale. We're talking about the full amount that is going to be affected by our bank. So the full amount we're going to receive as a result of the sale of an asset. And non-cash in statement of financial position, looking at our future costs included as part of the initial cost, is not a cash purchase. So here they're talking about like when we do that provision for dismantling and we capitalize it to the cost of our PPE, that again is a basic accounting adjustment. It's not going to impact bank itself. When we look at our journals, we see debit PPE costs, credit provision. Here, no impact on bank, so that would not feature within our statement of cash flows. Remember, we are working on a cash basis here, so a lot of those accrual principles and accounting adjustments are not going to feature in our statements of cash flows. And that is why a lot of investors really rely on the statement of cash flows more than your other financial statements, because they just feel that it is a more honest view of the company. Again, your revaluations and devaluations, going through OCR, not going to impact bank. We're not having any change in our bank accounts as a result of an increase or decrease in the value of PPE. We do have some non-cash entries, however, that will be processed through our statement of profit or loss. And these would be important when we look at our indirect method for the operating activity section. So where we want to eliminate those non-cash entries such as depreciation, impairment, and reversal of impairment, those items might potentially impact your indirect method when you are preparing these statements of cash flows for operating activity section. Most important here is we are looking for the proceeds or the physical purchases in relation to PPE. Your profit or loss on disposal, that's also non-cash or considered to be non-cash or seen elsewhere. Because, of course, if we have inclusion of our profit or loss in the operating activities or that profit before tax under the indirect method, we would then be double counting to show the full proceeds in the investing activity section. So your profit or loss on disposal is also going to be an item that is removed when preparing the statement of cash flows using our indirect method. Some more sections we would want to consider our intangible assets and investment property similar to PPE. These are our long-term, non-current assets, and we know that these ones will be included within the investing activities section of our statement of cash flows. So I-38, one close to my heart. I'm doing my PhD on intangibles, so very important section to me personally. Amortization, impairment, reversal of impairment. Why are we mentioning these here? They're going to impact us. Same with PPE, where we have non-cash items. We are reversing them when we are doing the indirect method for operating activities of the statement of cash flows. Revaluations, a similar procedure to PPE, where these changes in value are ultimately not hitting bank. If they're not hitting bank, we're not interested in it from a cash flow perspective. Profit or loss on disposal, again, you might want to eliminate that from the operating activities when you are dealing with the indirect method, because we're going to be showing the full proceeds under investing activities in relation to intangible assets. So same concept as PPE. Our main focus for intangible assets for the purposes of the statement of cash flow will be any potential sale of intangible assets. We'll want to show the full proceeds, the full amount we receive as a result of that sale, or perhaps purchases of intangible assets. And again, we would want to show the full value that we are paying for those intangible assets in the investing activities of our statement of cash flow. Investment property. Again, you might think I'm repeating myself here, but very similar to PPE. Investment property, again, we might have changes in value as we did with revals and devals, and those would need to be eliminated when we're dealing with the indirect method under the operating activity section, because in fact we would show those would be non-cash items. So those wouldn't ultimately impact the cash flow whatsoever. It's not hitting bank. Think of the journal entries when we have a fair value gain or loss. If we're having a fair value gain, we would debit investment property, credit fair value gain, not hitting bank at all. That's not going to be impacting our cash flow. If at cost, depreciation, impairment, and impairment reversals, similarly, as we've stated before, that will be important when we're dealing with the indirect method and we're starting from that profit before tax point. We then need to eliminate these non-cash items to be able to get the raw cash flow of the business. A couple of other sections that we are more recent to us, having studied them in Accounting 212. And that's why I said that, statement of cash flow is such an important section. Certainly is something that we can test a variety of topics within a single disclosure. So it can test a number of principles and ensure that you have some form of understanding of the mechanics of each of these sections to be able to determine what would be the bank or cash flow impact. Looking at provisions, your changes in provisions can affect profit or loss, but also asset costs. Okay, but it's not necessarily going to result in a cash flow. What is important and may impact your cash flow, though, relates to that interest expense. Now, remember, part of our operating activities will be interest that is either received or paid. Interest expense certainly might be an item that would impact our operating activities. We would want to see what would be the ultimate change in cash as a result of this interest expense. So more focus on operating activities, but particularly in relation to the interest that is attracted by the provision. Foreign currency transactions, you've got foreign currency gains or losses. Now, those wouldn't on their own impact bank, but we know at the end of the transaction, when you are either settling that debtor or creditor, or the debtor settling you or the creditor you settling, we know that then there's going to be some form of impact on bank, and especially if you have had some form of hedging, that would also be included within that bank impact when you are at that final stage and the settlement date. Okay, so that would be the only time foreign currency transactions would be impacting our statement of cash flows. The general translations at year end, those types of things are not hitting bank. They're simply updating the debtor or creditor balance and not impacting bank specifically to result in a change in our cash flows. Okay, so it's only at settlement date that we'll be focusing on foreign currency transactions with their impact on the statement of cash flows. IFRS 7, financial instruments, our favorite section. I know you're dying to do financial instruments again. Okay, financial instruments, always about perspective. Remember this, with our financial instruments, it's always about whose side are we approaching the question from. Okay, so say you have a scenario where company A invests in shares in company B, then from company A's perspective, that would be a financial asset. Okay, that financial asset, would it be under investing or financing activities?
Be finance, wouldn't it? Unless, actually, I could be wrong. Wouldn't it also be like, if you take out like the benches, then couldn't it also be like an investing activity?
Okay,
I could be wrong.
Financial instruments can be either investing or financing. And again, it's going to be important that we look at it from whose perspective. So in this example, where company A invests in shares in company B, company A has bought an asset. Where do all of our non-current assets go in our statement of cash flows? What other non-current asset do we have that's easy? PPE? Where's PPE?
Investing activity.
Investing. Okay. So if you have a financial asset, you've invested in another company, it's an asset to you. It's a non-current asset, something you're going to invest in for exceeding a period of 12 months. Non-current asset, we know, would then apply that as being an investing activity. But what if we were company B and we were the ones who sold our shares? So if we're selling shares to an investor, company B's perspective, what type of activity would that be in the form of cash flows?
Financing.
Financing, okay, because it would be equity to them. They're selling their shares, being an equity section. So very important financial instruments. It can either be part of your investing or your financing activities, depending on our perspective. Do we have a financial asset or do we have a financial liability? Or is this just a pure equity type of transaction? Those are the things we're going to want to ask ourselves. If it is in fact a financial liability or an equity, pure equity type transaction, it would form part of our financing. Whereas if it is a financial asset to us, it would form part of our investing. Okay, so very important perspective and how the companies have structured that particular transaction. Preference dividends are included as finance costs. Finance costs, we know, are going to impact interest, which is part of our operating activities section. We're going to want to play with that a bit there. So please do join me on Friday. I actually look at financial instruments with cash flows for a theory question. So how's that for a triple threat? Okay, so we'll look at a nice integrated question. I've uploaded it to Learn for you to look at, and our solution will be available on Friday after the lecture. Ordinary dividends declared but not yet paid. Think about it. Is that going to impact bank? Certainly not. It would impact our shareholders for dividends. But shareholders for dividends, we would want to see, has there been any opening balance? This might be part of a closing balance. Was there perhaps a payment made during the year? All the types of things you need to consider. Movements in share capital that do not result in cash inflow outflow, things like conversion of shares. So from converting ordinary shares to preference shares or preference shares to ordinary shares, simply an equity movement and not hitting our bank whatsoever. Similarly, with share splits and share consolidations, we're just changing the number of shares. And we know that those two sections, in fact, don't result in journal entries at all. You're only going to notice that there was, in fact, a share split or a share consolidation in the share capital note, where you see the number of shares that are actually in issue. Capitalization issue. Remember, these are shares that are paid up or free from the perspective of the shareholder, because how are they paid for? How are shares paid for under a capitalization issue? Yes, they're free to the shareholders, but the money has to come from somewhere. We can't simply credit equity and debit nothing.
It comes from retained earnings, doesn't it?
Absolutely, yes. Comes from retained earnings. We're using our existing profits that have accumulated, and that is what is used to pay for those shares. But is it hitting bank at all? Debit retained earnings, credit share capital, not hitting bank, not impacting our cash flows. So a lot of things to consider. Another one that doesn't impact our cash flows, and we'll look at a little bit more on Friday, is things like your exchange of assets. Remember, when you are in PPE, you're going to perhaps swap a vehicle in exchange for a machine. Again, not resulting in a cash flow transaction, not going to hit bank, and therefore is not going to feature as part of our statement of cash flows. So that type of information you'll find elsewhere in our financial statements, but you're not going to find it within the statement of cash flows, because here we're looking at the real hard cash is king. We do have a general approach to our cash flow questions, and this is just a quick reminder of these before we go into our example 4 and start looking at the mechanics. Know which items fall into operating, investing, and financing. So that's why I went through all these sections with you to say, well, what do we know about these sections? Where would they feature in the statement of cash flows? Where would they impact it? And thinking about all of the various movements within those accounts as well. Remember, if in doubt, draw up a T account. T account, that little general ledger account, fill it in as much as you can, and your balancing figure ultimately being the change in cash, the change and impact in bank. For us to draw up these accounts, you firstly want to insert your opening and closing balances. Typically, with your statement of cash flows, you're going to be provided with a trial balance or something along those lines, and you'll have opening and closing balances. Follow the additional information and insert journal entries into the T accounts. So use the information that you have at hand in the question and complete those accounts as fully as you can. Remember, in your tests and exams, paper is free. And you can use as much of it as you like. We're not going to lose your books. Fill it in. Use the paper. Go over the next page. You don't need to cramp it up and draw me these tiny, like 700 tiny little T accounts on one page. And I mean, we're old now. We're going blind. We can't sit and look at where all these tiny little figures are. We will try our best, but spread it out. Don't limit yourself, especially when you get your additional information and you now see you need to fill in 7 lines on the right-hand side, and you've now drawn it on a little one-liner. Okay, space your work out. Paper's free. You don't have to stress about it. They will give you more paper. I know as a student, those invigilators, they're also old. They take time to get to us. So when you start getting to your last page, just carry on writing with one hand and put your other hand up and get them to start coming along with that spare booklet for you. Once we've put in all the information, we filled in as much as we can into these T accounts, we then want to balance them out with that balancing figure reflecting bank. Okay, so that's going to help to tell us, has there been an inflow into bank or has there been an outflow? That bank amount that we have calculated as a result of our T accounts, we're going to put those into the relevant section in the statement of cash flows. Is it part of operating, investing, or financing? And very important to reference your workings. So don't put just a random figure there and no working to it, because then we can't award you those part marks. We really do want to give you maximum marks. So when you have a figure, reference it back to where that working is. So if in the hopefully unlikely event your figure is wrong, we can at least look at your workings and award you those part marks. And now we're going to get to the main event of today, and that is example 4. Example 4 is quite a big example, but it is going to give us a nice, well-rounded look as to statement of cash flows. And we're really going to go right into it and look at it from both the disclosure of a direct method and indirect. Okay, you should always be told in your question whether you must use the direct or the indirect method. If they are silent, they have to mark both methods. You can see which one perhaps more information is provided for. But if both are acceptable and both are capable of being done with that particular question, then they need to mark both of those as correct. Okay, I do have a question saying, is it possible to get a theory question on cash flows? So yes, Natasha, absolutely. And we are going to go through one of those very scary theory questions on cash flows on Friday. So the question is uploaded for you on Learn, and the solution will be available to you on Friday, I think at 11 o'clock. So probably just after our lecture or during our lecture, it will become available to you as the solution. So for now, you can at least download the question and have that nice and ready for us to go through on Friday. So example 4 in our Gripping Gap question is Frodo Limited, and we are given a statement of financial position. So this is one of the common ways for them to provide you with information for a statement of cash flows. They can provide you with a set of financial statements in terms of the statement of financial position, and then your statement of profit or loss. Okay, so that's what they've provided to us. Or they can provide you with a general trial balance. Both of those are acceptable and quite easy to then use to draw up a statement of cash flows. So we're given a number of items here. PPE, we expect that to come through in investing. Inventory, expenses prepaid, trade receivables, that will form part of a working capital if we're doing the indirect method. Bank, very important balance, because that is going to be that reconciliation at the bottom of our statement of cash flows. And as we can see, it moved from a balance of 10,000 to 112,000. So there was a cash inflow of 102,000 Rand. We then have our equity and liabilities, which quite a lot of will form part of our financing. The only parts that will possibly part of operating is those short-term or current liabilities. So share capital, retained earnings, deferred tax liability, our loan. We've got shareholders for dividends, expenses payable, trade payables, and current tax payable. And so a nice large variety for us of different topics that are all included within a single question. A statement of profit or loss, we've got the profit before tax, which we're given an extended note that will particularly be important when we get to our indirect method, because we want to eliminate any non-cash items or those that are shown elsewhere in our statement of cash flows. We're given the income tax expense. It's going to be important as we look at our current tax payable and our current income tax expense to be able to determine how much was in fact paid during the year. Our profit for the year, and there was no OCR, no other comprehensive income. Our profit before tax, they've provided us with the breakdown, including sales, cost of sales. Those will be important for us as we work out what was in fact received from our debtors and paid to our creditors. We've got the profit on sale of plant. We know we're going to want to eliminate that, in particular for our indirect method. Depreciation as well, eliminate for indirect. Impairment loss, our credit loss impairment of trade receivables, so some form of bad debts that were written off, our other operating, distribution and admin expenses, and then our finance charge as part of interest. We're also told that a plant with a carrying amount of 80,000 Rand was sold during the year, and all purchases and sales were in cash. So the important thing for us we were going to want to know what was the proceeds of this. So simply having a carrying amount is not going to be important for us in terms of cash flow. We're going to want to know what was the debit bank amount, how much was actually received as a result of the sale of plant. There was a capitalization issue, so we know that impacts our retained earnings. Market price of 10,000 Rand during 20X2, utilizing retained earnings. And there was a further issue of ordinary shares during 20X2 at a market price of 4 Rand each. And so that will be more important to us, the further issue where we're going to want to see how much did we debit bank, how much was received as a result of these shareholders investing in the company. A loan repayment of 20,000 Rand was made to Gotcha Bank in 20X2. This constituted 80% repayment of interest and 20% repayments of the principal debts, and no other repayments were made. So that's going to be important in terms of our loan, which we know will form part of our financing activities. Dividends of 40,000 Rand were declared during the year. We know this will impact our dividends paid under operating activity section, and there was no tax relating to OCR. And we start off working with our workings. We want to work out what all our workings would be in terms of these T accounts. And if you aren't comfortable with drawing up T accounts and you simply want to write 30 plus 800 minus 50 minus 40 for trade receivables, you can. That will also be marked correctly. I just like to do the T accounts because visually it's just a little bit more easier to gain a deeper understanding. To get our cash receipts from customers, we're going to focus on our trade receivables. That will form part of our customer balance. We want to input our opening and closing balance. Remember our steps for statement of cash flow questions. We firstly input the opening balance and the closing balance, and that is derived directly from our statement of financial position given to us in the question. Opening balance was 30, closing balance was 40. Opening balance is on the debit side, so asset, it's going to be on the debit side. Closing balance on the opposite side on 40. And we want to then populate this section as much as we can. We know trade receivables, these are in fact purchases from customers. So one of the impact then would be in the form of sales. Okay, sales, from our question, we're given the information in additional information 1. It's a value of 800,000. We then process that on the debit side. And we then also had a write-off. Okay, that was shown in the additional information number 1 as well. Third from the bottom, it said credit loss impairment of trade receivables. So that's some form of bad debt write-off. And we know that a bad debt write-off would be processed on the credit side of our trade receivables accounts, therefore meaning that our bank value would be represented by 740,000 Rand. So that's going to be an inflow for the company in terms of cash receipts from customers, and we'll show how that fits into our disclosure as we move forward after our workings. Cash paid to suppliers and employees. This section is actually quite bulky. When you get to cash paid to suppliers and employees, it's not simply a single tier account that we need to consider. Because remember, suppliers, it is not simply your creditors. We're not only talking about the people we buy inventory from. Oh, that is also important in terms of people who possibly you pay rent to, the municipality, you're paying water and electricity. So all your operating expenditures would need to be included. Those are also forms of suppliers, and as well salaries from our employees. So we start off with inventory, trying to work out what in fact our purchases were, and those purchases will filter through to our trade payables for us to actually ultimately determine how much was bought from our creditors for the purposes of inventory specifically. Starting off, our very first step is to populate our inventory account with the opening and closing balance. So taken directly from our statement of financial position, 100 and 120,000, opening balance on the debit side, closing balance on the opposite side. We know that ultimately inventory is impacted by cost of sales. If we think of the sale of an item, it is going to be debit, bank, credit, sales, and the second leg of that transaction is debit, cost of sales, credit, inventory. Okay, so let's get our cost of sales. It's 350,000 Rand as included in additional information number 1. Okay, we've got all the information we require from inventory to determine what our purchases were for the year, 370. That is then pulled through to trade payables. Now you'll see it being green on the credit side of trade payables, the inventory purchases that we have pulled through from inventory. Okay, so that's processed there directly. We want to also populate with our first step should be opening balance and closing balance for trade payables, taken directly from our statement of financial position. Trade payables, we have our opening balance is 20, closing balance is 10. This opening balance is going to reflect on the credit side being a liability, closing balance on the other side of 10. And we can then balance our accounts, and that will give us a value of 380 relating to bank. Okay, payments, it's going to be an outflow. It's on the debit side of trade payables. That means then in the bank account, that would actually reflect on the credit side being an outflow. Our expenses prepaid and our expenses payable, same concept, process our opening balance and our closing balance. And we also use our expenses that were actually incurred during the year. And you'll find that that should come directly from our OPEX, our operating expenditure that we are applying. And so expenses prepaid, our opening balance and closing balance, taken directly from our statement of financial position. 6 and 5 for expenses payable. Okay, so that's the one at the bottom, 6 and 5. And then we would work out what our expenses are. Okay, so ultimately that would be settled on an annual basis. So it's nothing too crazy there. Whatever your opening balance is, it would typically be counted and accounted off at the beginning of the current year. So the same with the expenses prepaid. Our opening balance of 10 will be paid or reversed during the current financial year with 10. That then means the current year we would have expenses prepaid recorded at a value of 8 to get our closing balance of 8. Similarly, with expenses payable, our opening balance of 6 is reversed on the very first day of our financial accounting year. So think back to your accruals from first year. That would then be processed during the current financial year. If we have a closing balance of 5, that then means for the current financial year, an expenditure of 5 was processed. Okay, so that is typical for our accruals that would be processed on an annual basis with the initial reversal. Operating, distribution, and admin expenses. And this is going to be a little bit, more along the lines of where we're actually determining our bank. Sorry, I see a question. Could you please repeat that? Okay, so the accruals. And the accruals is not important because, as you see here, the expenses prepaid and the expenses payable, ultimately there's no impact on bank. So you're not going to actually have these feature in your statement of cash flows, because what is happening, these are going to ultimately filter through to our OPEX on the next slide. So I wouldn't be too stressed about this. They did include it in your gripping GARP. What they've done here is the opening balance of expenses prepaid or prepaid expenses would be 10. If you prepaid them ultimately, at the end of, say, December last year, in January this year, it would then be incurred. So that 10 would be an expense for the current year. When you look at it and you say, well, I've got expenses prepaid of 8 at the end of this current financial year, that then means we've processed an additional 8 for this year as a form of expenses prepaid. Okay, but again, this, like I said, is not going to be important for us. These figures are not featuring or not hitting bank whatsoever. What is important is the amount of expenses prepaid and payable that were actually impacting us during the year, to be able to determine what is the bank that is going to be hitting our statement of cash flows. So that's why our operating, distribution, and admin expenses, that is what is important to us. That is what's going to hit bank. So they included it here as a form of completeness, but as you can see, nothing's highlighted in yellow, nothing is impacting bank, and honestly, in a test or exam, you would not have marks allocated to this. It's not important, it's not impacting bank, and it's not going to be something you'd be expected to calculate. What is important is here, our operating, distribution, and admin expenses. Here we are seeing our prepaid expenses and our accrued expenses actually featuring, and are going to help us to determine what was the actual bank amount, what was actually paid in cash as a result of these balances. So they've included here our prepaid expense opening balance at 10, our prepaid expense closing balance on the credit side at 8, and then contra for our expenses payable or our accrued expenses, opening balance on the credit side, closing balance on the debit side. And then they have here profit or loss 60. Where does that profit or loss 60 come from? Comes directly from our profit before tax note in additional information 1. Second last row in that table says other operating, distribution, and admin. That is what is important to us, because that is going to be some of the expenses that the business is physically paying during the financial year. Once we do this, we've populated this particular account, we can add up, and we see that the credit side is definitely much heavier than the debit side. And for us to balance this out, we would have to have bank of 59,000 Rand. That then means 59,000 Rand would be paid out as a result of these operating, distribution, and admin expenses. To then actually determine what is the total paid to suppliers and employees, and that would be included here. Operating costs, this P&L of 60,000, salaries is included in that. It's all the general expenses that are paid by the entity. So we would want to include that 59, the bank, as a result of this T account. The other one we'll want to include is the 380 from trade payables, and that will give us our total that is paid to suppliers and employees of 439,000. That's going to be important for us as we go through and provide for our disclosure. And we then look at plant. This is a nice little bit more complicated one. Plant's got a lot more mechanics involved that we would need to consider. Also included a couple of little others here that you might want to look out for in your plant T account, starting off with the opening balance and closing balance taken directly from our statement of financial position. We then want to populate this as far as we can. We know there was depreciation, disposals, and impairments. And the depreciation was 50,000 Rand provided from our additional information one. It's the fourth line down. Impairment was 10,000 Rand just under depreciation. And we also had profit on sale of plant. But that's not what's going to impact our plant account. Our plant account is going to be impacted by the carrying amount that's provided in additional information two. Additional information two, we had 80,000 Rand that was sold during the year. We expect to see that coming through on the credit side of our plant general ledger. And so here we have our depreciation. It's decreasing the cost and the carrying amount of plant. So it's on the credit side. Disposal of 80,000. Yes.
Just I've got a question here because I feel like for me, just out of curiosity, it would be easier for me in a test if I didn't construct a T account, but I did something similar to like what you see in your SOCR or your trial balance. So I would have all the money inflows to bank. I would put, and then below that, each step, the stuff that's outflows in brackets. And then I'd calculate my final value of bank as either a gain or a loss. So either there's an inflow of cash to the bank or outflow. Am I allowed to do that in a test?
Yes, you absolutely are.
Perfect. Thanks so much.
Absolutely. So your tests are marked by CAs. I think that Artie and I are going to be marking for the rest of the year. So we are very happy to be able to mark in that manner. If you simply do outflow, inflow for plant, we'll be able to see from the T account in the solution if you've put the correct figures and the correct signage. Have you done it as a minus? Or have you done it as a plus? We'll be able to see that and mark you accordingly. So you're more than welcome to set out your work as you please. We cannot dictate to you how you do your workings. Everybody's minds work differently and structure things differently. Happy to mark it as you prepare it. I mean, we get hundreds of different solutions from students, and there's very often many different ways that solutions have been set out, and they're correct. So we have to mark it accordingly. Definitely can't mark you down. You're welcome. We can't mark you down or differently simply for your layout. No, definitely workings are individual and will be marked in that way as well. And we've got our disposals there, of course, decreasing the value of the plant carrying amount or cost account, and would be on the credit side, as well as impairment. We know that, again, is devaluing and reducing the value of our plant. Potential increases in value may be revaluation surplus. So I've included it there on the debit side as something to think about. Wasn't in this question, but you might have one, and you can then simply insert that as well. And capitalized finance costs. You could even have things like those provisions that have been capitalized to the cost of the plant. Those are types of things you would want to consider when you are preparing your T accounts. Ultimately, we find that we have a debit value. So that means plant actually increased. So they told us in this question that we had the sale of a plant, but they didn't tell us that they actually bought a plant as well. And that was for 190,000 Rand, which we have figured out through the use of a T account. I've put a little note under the T account there to say that the proceeds is what is important for investing activities. Remember, proceeds is the total value for which the plant was sold. Now, if the carrying amount was 80,000 and the profit on sale was 10,000, that must mean then that we sold the plant for, in fact, a value of 90,000 Rand. And that full proceeds of 90,000 Rand will be reflected in our investing activities. Now we get to the interesting part as we deal with our taxation. Now, deferred tax, while it is an accounting entry, you might find scenarios where that's going to impact income tax, which is going to be important for us. as we work out our current tax payable to determine how much was actually paid. I mean, if we had an opening balance of current tax payable of 12,000 and our closing balance is 15,000, that certainly means, we didn't only have 3,000 Rand of tax this year. If we look at our statement of profit or loss in this question, we in fact had an income tax expense of 110,000. So there definitely was a payment made for income tax, but we don't yet know how much. So we use our population for deferred tax liability and our current tax payable. We're using those opening and closing balances, and we're keeping in mind the current year's income tax expense of 110,000 Rand. We want to include all this information into our tax journals to be able to determine how much of that current tax payable was actually paid. What was the impact on bank? As I put them nice and neatly here all together on one slide, focusing on tax. We input our opening balance and closing balance for the deferred tax liability. Income tax, okay, we don't have much there yet. All we do have is the profit or loss value of 110,000 Rand that was actually incurred in our current year's statement of profit or loss. We then have our current tax payable, opening balance and closing balance of 12 and 15. And we then go through and start with our calculations. We start with balancing our T accounts. So our deferred tax liability, if the opening balance is 70, closing balance is 80, we know we need an additional 10 on the credit side. And that 10 is going to be taken directly through to income tax expense. Okay, income tax expense, we now have only the top line in terms of our actual workings. Deferred tax liability of 10, the profit or loss for the current financial year taken from our statement of profit or loss of 110. That then means that 100,000 will be taken directly to our current tax payable. We pull that through to current tax payable, and we can then balance this account to actually see how much was physically paid over to the South African Revenue Services. If we look at our credit side, it's sitting at 112, and our debit side is sitting at 15. That must then mean we paid over a value of 97,000 Rand to the receiver of revenue for that financial year. And so a lot of accounts may not impact banks specifically, but we know how they're all linked together and how they will ultimately filter through to that one that we are interested in to determine what the change in cash flow was. And we also had a loan. If we look at our loan, we had an opening balance of 50,000 and a closing balance of 60,000. We were also told that there were two physical accounts that were paid during the year. We were told that we were paid 40,000 Rand, but they actually split it between what was paid in terms of the loan balance itself and what was paid in terms of interest. And so always important that we refer back to the question. If we look at information 4, a loan repayment of 20,000 was made to Gotcha Bank in 20X2. This constituted 80% repayment of interest and 20% repayment of principal. No other payments were made. And then we have our information relating to our loan specifically. Okay, loan, they also referred to note 4, having an opening balance of 50,000 and a closing balance of 60,000. And so all elements that we'll want to include in our actual T accounts. In this case, they've got the interest expense of 20,000 that was incurred during the year and being processed, and then balancing again what is going to then be a bank loan that was in fact raised. So in this case, we haven't again been told that we actually incurred and took out additional loan. But through the use of the T account, we found out that for us to balance it, we had to have something additional on the credit side. That must then mean that we actually took out further 30,000 Rand in terms of the loan. Okay, so important to do these T accounts because you quite often find out information that wasn't included. Yes, the repayment should be 40,000 and the interest is 20,000. Thank you so much. I just had a question on the chat. Yes, I do see in my question I've written a bit of a typo. The repayment was 40,000. And that's split between the principal and the interest for the current year was 20,000. So I'll amend that for you and update these slides on Learn. Seems I had a bit of a typo there when looking at the gripping gob question and didn't quite include that in the correct manner for note 4. But I will update that for you as long as you get the understanding that the repayment was 40,000 split between the principal and the interest. The interest for the current year was 20,000. Therefore, we have an unknown balance on our credit side, which must mean we had an additional loan that was raised at a value of 30,000 Rand. Our shareholders for dividends. And we're looking more along the lines of our equity here on this side, looking at our shareholders for dividends, our share capital, and our retained earnings. So our shareholders for dividends, starting off with the opening balance and closing balance, taken directly from our statement of financial position. We then look at our additional information, and additional point 4 stated that dividends of 40,000 Rand were declared during the year. So of course, if these were declared during the year, we are going to have that showing as part of our credit side of our shareholders for dividends. Therefore, that must mean that a physical payment was made to the shareholders of a value of 12,000 Rand that is reflected on the debit side of the shareholders for dividends accounts. Our share capital, we also had a share issue here, and that is what is going to be important for us. We want to see how much money did we actually receive as a result of issuing those shares. So we provide our opening and closing balance. We did have a capitalization issue, which we said was going to be paid from retained earnings. And we then wanted to know, well, how much was actually received as a result of issuing the further issue of ordinary shares. So if we look at additional note 3, told us that there was a capitalization issue, and that was going to be at a value of 10,000 Rand. But there was a further issue of ordinary shares at a market price of 4 Rand. But they didn't tell us how many shares. If they told us it was 10,000 shares, we could say 10,000 shares times 4 Rand each. 40,000 Rand was received. That was the bank cash inflow. But in this case, they didn't tell us how many shares were sold. So we had to rely on our general ledger. And that's what we did here. We've started off with our opening balance of 60,000, taken from our statement of financial position. We then said the capitalization issue would be debit retained earnings, credit share capital with 10,000. And then we said there was an issue for cash. It would be debit bank, credit share capital, and we didn't know what the value was. So we balanced our accounts out, and we then found that this missing value on the credit side was a value of 20,000 Rand. We therefore know now how much was actually sold in terms of our shares. Okay, they then have for completeness a retained earnings T accounts, not going to impact bank, but they do provide it just for your information. They have there the opening balance and closing balance. They have the value coming from the statement of profit or loss. So if you think of your statement of profit or loss, profit for the year, being provided and included in retained earnings. We did have some distribution of earnings, one through the dividends that were declared of 40,000, and we also had that capitalization issue of 10,000. So they did include that just for completeness purposes, but there was no impact there on bank whatsoever. We then have a nice little cash flow table, and I found this quite important to use because I thought it was a nice way to show you how everything we've calculated up to this point, I've given them little references 1, 2, 3, 4 to 10, and how those are then reflected in the indirect and the direct method. Okay, so our cash receipts from customers, what working? we used the trade receivables T account, and we found that the bank value was an inflow of 740,000 Rand. Cash payments to suppliers and employees, we used the trade payables T account, the inventory T account, and our operating expenses T account to get an outflow of 439,000 Rand. We then had a plant that was purchased. We actually found that out when dealing with our plant T account, and we know that that's an outflow of 190,000 Rand. We bought something, it's an outflow. Plant was sold. What is important is the proceeds. We got this from the question. We used the carrying amount plus the profit that was made to get what the actual proceeds was. And we found out that was 80,000 plus 10,000 to give us 90,000 Rand. Our tax paid, we used our current tax payable as well as our tax expense and deferred tax accounts to get the ultimate tax paid, which was an outflow of 97,000 Rand. Our interest paid was in relation to the loan, and we were able to see that that loan specifically in terms of the interest was a repayment of 32,000 Rand, whereas the repayment of the loan for Part 7, loan principal paid, was 8,000 Rand. Now, why have I split this loan between the interest paid and the principal paid? Where does the interest expense and the interest paid go in terms of our disclosure for statement of cash flows? Yeah, interest expense will form part of the operating activities, whereas the repayment of the loan is part of financing activities. So that's why we've shown this separately. It's going to be important in terms of our disclosure for cash flows. The loan raised was calculated using that loan account, and we actually discovered that a further loan of 90,000 Rand was taken, of 30,000 Rand was taken out by the company. There were also dividends paid using our shareholders for dividends accounts to see an outflow of 12,000, and share issue proceeds through share capital account. We were able to determine that we raised 20,000 Rand by actually issuing set of ordinary shares. If we look at all these amounts and we add them all up, we get a value of 102,000 Rand as an inflow. And when we started off this example, we said, well, the bank opening balance is 10,000, the closing balance is 112,000. There's been an inflow of 102,000. And here we have evidence of that. We then know that our workings are correct, and it is reflective of the movement in bank for the current financial year. But of course, this is not how we are going to provide for our disclosure. What is important is we need to determine, must we use the direct or the indirect method? Okay, so we are quite particular in your tests and exams to tell you to use the direct or indirect method, especially if we are asking you to either draw up a full statement of cash flows, or if we're asking you to draw up just the operating activity section of the cash flows, because it doesn't matter for financing and investing. They're both the same under both methods. So like it says here, remember, only operating activities portion is going to be different between these two methods because both the investing and financing are the same. And so this is just a little reminder of the question here. And we then look at our direct method. So for this disclosure, we have our cash flows from operating activities, and this is going to be made up of a number of items. So we start off with our cash receipts from customers, and that is taken as number 1, reference number 1 from our table, and we plug it in here. Cash paid to suppliers and employees, reference number 2, we plug it in there. That will then give us our subtotal being our cash generated from operations. So if we take 740 minus 439, we should get our total subtotal of 301. We then have our interest paid, dividends paid, and income tax paid, reference from our table of 6, 9, and 5. And we see these are all outflows of 32, 12, and 97. If we take those figures from the 301 subtotal, we'll get our cash flow from operating activities right at the top of 160,000 Rand. Our cash flow from investing activities, We then have our proceeds from disposal of plant. That was a value of 90,000 Rand, a reference of 4. We have our purchase of plant. And that was 190,000 Rand, as we discovered from our T account. That then gives us our cash flow from investing activities. Okay, everyone following so far? We then have our cash flows from financing activities. Here we've got a number of items that we actually discovered, and we're using our table for that. Loan repaid of 8,000. We then had proceeds from loan raised and proceeds from the share issue to get our total cash inflow of 102. Okay, and then that would then reconcile back to our opening and closing balance. If we look at our little reference column here, you don't have to do a reference column. It's just nice if you've got workings to be able to show the marker exactly where those figures come from. We can see here that we've got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So all the references are included there, and that then means we have included all the items directly from our table. Okay, so those are what you want to look out for when you are preparing under the direct method. And we know that our indirect method is a little bit different. Yeah, so there's quite a little bit more working involved here. It's not as simple as simply taking the information directly from our references. Okay, what is important is the only difference here is going to be this top part where it says cash generated from operations.
Can I ask something?
Yes.
If it is more difficult, why don't we just rely on the direct method? Or is there an advantage that applies to the indirect method?
It really is a personal preference in terms of disclosure. Some companies just like and prefer the indirect method. I know SPAR head office, when I was working there, they much preferred to have the indirect method. I mean, there are advantages to both. It kind of depends on what you're trying to disclose and what you're trying to highlight. Your direct method, while I say, yes, it has less, it's a little bit neater, it's a little bit nicer, you're still going to find there's going to be a lot of notes to the financial statements for the direct method. So your cash receipts from customers, this random 740,000 Rand here, your users of the financials will say, well, where did you suck that number from? How on earth did you get that? So there is a note that you'll prepare to provide that reconciliation. And as an accountant, as an auditor working at a company, you're going to actually use that note, and you have to reference all that back to a statement of financial position, to a statement of profit or loss, to a profit before tax note. Everything has to be referenced. So you can't just have a random figure that is chucked out there and forced to balance or something like that. It has to then provide all that information anyway to some degree in the note. So it's here nor there. I like the direct method. I think it's a little bit neat. There are a lot of companies that do use it and then have the detail provided in the notes to the financial statements, as opposed to the indirect method where you've still got quite a mess here, but you're still going to have to, as an auditor, in the workings and in your work papers, you still have to reference every single figure to, the trial balance, the statement of financial position. Everything has to be referenced. That there won't be any fudged numbers anywhere. So it does involve quite a bit of work. And as the probably second year or third year, generally they're the ones who are stuck doing the statement of cash flow, because there's going to be a couple of rands here or there that are missing, and it can be quite a pain to find when you're dealing with a company with thousands and thousands of transactions. So it can be quite a pain in the neck doing statement of cash flows. I can assure you that's probably one of the least liked sections in practice. And you're going to try not draw the short straw for that one. But of course, you do need to do it at some point to get all your SARC competencies, but it's not the most fun section to do in an audit, I'll tell you that much. Profit
Thank you so much.
No, you're welcome. Profit before tax, a statement of profit or loss, It's taken directly from our statement of profit or loss, so you don't have to stress about that. You can reference it directly back to your statement of profit or loss. Your adjustments, a lot of this is going to come from the question directly. So your depreciation, non-cash transaction. This is part of our additional information number 1. Payment loss, also a non-cash item. Profit on sale of plant, that is shown elsewhere. It's shown in investing proceeds, the proceeds for the sale of the plant. And interest expense, it's also shown elsewhere. It's shown below cash generated from operations. It's the 3rd row from the bottom. So we are eliminating it there at that point. We don't want to double count it. We then have our operating profit before working capital, and our working capital is going to be important in terms of working out our opening balance and closing balance for each of these 3 elements. We find our trade and other receivables, the opening balance is 40,000, increased to a balance of 48,000. Okay, because it was an increase, we're showing it in brackets. What is important is that this balance did not only include trade receivables. The opening balance was trade receivables and prepaid expenses, because it's increase in trade and other receivables, not simply trade receivables. Inventory, nice and easy one. We don't have to worry about anything else there, taken directly from our statement of financial position. Opening balance of 100 up to 120, it therefore was an increase, and we show that outflow of 20,000. We had the contra taking place for trade and other payables. And again, remember, we're not only focusing on creditors here, we are also going to include our accrued expenses. In this case, we went down, decreased, and will be reflected as a negative value. Cash generated from operations, and then we deal with our interest paid, dividends paid, and income tax paid. As you can see, this cash generated from operations is 301,000 Rand. What is our cash generated from operations under the direct method? So 4th line, 301,000 Rand. So we can see that the cash generated from operations, despite which method we use, we are ultimately going to get the same figure. Cash generated from operations under the direct method is 301,000 Rand. Cash generated from operations under the indirect method, also 301,000 Rand. Okay, so that is, as we can see, the difference is that massive working above, but ultimately we end up at the same place, and everything from that point onwards is the same, whether using direct or indirect method. Okay, netting off cash inflows and cash outflows, we're looking at a bit of the basics here. What is important is cash flows are generally disclosed on a gross basis. So we normally use the entire value. However, there are certain instances where we can use that reduced value, and a net basis is allowed. There are 2 camps that we need to consider when looking at being able to net off cash inflows and outflows. For non-financial institutions, cash received and cash paid on behalf of the customer, and these cash flows represent the customer's activities. And cash received and cash paid for items that are returned over quickly, and amounts are large and maturity periods are short. Where you have financial institution, you look at cash received and cash paid when accepting and repaying deposits that have a fixed maturity date, or when placing or withdrawing deposits with other financial institutions, or providing loans or receiving payments to or from other customers. And so these are just the broad, generic requirements in terms of being allowed to net off certain figures. And we're going to look at this from the context of an example. So example 7 in this scenario, an estate agent collects 10,000 Rand rent from a tenant and pays the client, who is in fact the landlord, 9,000 Rand after deducting commissions of 1,000 Rand for overseeing the rental agreement. In this case, they ask you to calculate the cash flows to be disclosed. Can you disclose the net amount and why? Okay, so in this case, yes, you can disclose the net amount, which is 10,000 less the 1,000 commission at a value of 9,000 Rand. Okay, this is a property rental. It's a non-financial institution because it is also a third party and as a result of the customer's activities. These cash flows represent the customer's activities. Okay, so that would then be permitted to show on a net basis, and it makes sense. It is all with the same customer. It's all as a result of the exact same transaction. There's nothing here that you would need to show on a separate basis. You simply receive the net value. Another example, in this case, entity A raised and repaid 2 loans during 20X2. A loan of 100,000 Rand, which is repaid within 3 months of receipt, and a loan of 150,000 Rand repaid within 9 months of receipt. You're required to disclose the above in the statement of cash flows. Okay, we're assuming that there's some form of non-financial institution. 100,000 Rand, 3 months is a very short period, and thus the loan and receipt may be offset in that case. Okay, so for the 100,000 Rand being repaid within 3 months of receipt, we can simply offset that off one another. However, with the loan of 150,000 Rand repaid within 9 months of receipt, that would then be required to be shown separately under the financing activities. And because it is a fairly long period of time, it exceeds 3 months, we would then be required to show the loan raised as an inflow and then the loan repaid as an outflow. Okay, just a little bit of more information on cash and cash equivalents. Not something that is typically difficult. Quite often you're going to use the bank value from your statement of financial position or your trial balance, however it is provided to you in the question, where cash is being defined as cash on hand and demand deposits, something that is very easy and liquid, something that you can very quickly gain access to. Cash equivalents being defined as short-term, highly liquid investments. They're readily convertible, short maturity dates to known amounts of cash. So something that is going to be short, typically less than 3 months, 3 months or less, and subject to insignificant risk of change in value. So this is really a rehash of some of the information we went through in our previous lecture. Now, bank borrowings are normally considered to be a financing activity when we think of things like loans, etc. But we do have an exception where things like such as a bank overdraft can be included in cash and cash equivalents. It would be on a negative basis, so you would have it in brackets. You can include that in cash if it's repayable on demand and integral to cash management. Okay, so quite often, if that is your bank overdraft, you are going to be using it as some form of working capital to maintain the operations of the entity on a daily basis. Quite often, you'll find that those balances do fluctuate between negative and positive, depending on the inflows and outflows of cash on any given day. But clearly, they are quite borderline in terms of being in a positive manner. Okay. Disclosure specific to cash and cash equivalents. So the total cash and cash equivalents as per statement of cash flows may not equal a line item in the statement of financial position. So that's what we're talking about. As we look through our proceeds from customers, I think it was 600 and 740,000 or something along those lines. Your users of the financial statements are going to say, well, where on earth did you get that figure from? It's not in your statement of profit or loss. That's not sales. That's not anything. So where on earth did you get it? And that is why the notes are so important. You will find that all these figures that are provided in your statement of cash flows, even if they are not readily available in your financial statements, then there must be a note to provide evidence of where all these figures came from. Okay, so ultimately you'll find in your note, oh, then you can reconcile it to the statement of financial position. Oh, that figure did come from statement of profit or loss. Oh, that figure did come from the profit before tax note. So you can actually reconcile all those figures back to a valid audited figure in the statement of financial position, or your other set of financial statements. Your notes should include items that compose cash and cash equivalents. So if you've got cash plus a short-term deposit or a 32-day call deposit, you would need to include that as a note to show how did you get that cash opening balance and cash closing balance. You'll also have to provide some form of accounting policy to say, well, what do you use? What are your criteria for either including or excluding something as part of cash and cash equivalents? And that would be along the lines of your accounting standard for the statement of cash flows. Looking at interest, dividends, and tax, your interest and dividends paid could be classified as being part of operating or financing. So that's quite interesting. There is a argument in the accounting world to say, well, interest might form more part of financing than operating activities, or dividends is part of equity, so it should be included in financing and not in operating. So the default or the norm is that we do include it as part of operating activities. If the question is silent, you would be expected to include it as part of operating activities. Only if you're specifically told that it forms part of financing or investing activities, whether it's paid or received, then you would actually take that out of operating activities and include it in either investing or financing, depending on the statement provided on the question. Okay, so like I said, if the question is silent, we include it under operating. But if the question says, which you'll actually see on Friday, we have a scenario where they tell us interest is included, I think, in financing activities, then you must do so. You would then change your disclosure in that case. So we'll look at that as well in a bit more detail on Friday. Then just to finish off for today, we are looking at a reminder from leases. So leases feels like years ago. We did it in 211. Leases from the perspective of the lessee. And it's just a reminder to tell you that, remember, a lease gives rise to two items. When we introduce a lease into our books, we immediately raise a right of use asset and a corresponding lease liability. Now, what is important in terms of the cash flows is we want to understand how this would be disclosed. The payment of the lease installments have to be split between what is the principal portion forming financing activity and what is the interest portion forming part of normally our operating activities section. And we saw that coming through with the loan in example 4. It had the same type of scenario where the repayment went one way and the interest went to the other way, went to operating. So very similar concept here with leases as well. And we finish off looking at example 12, where Yusuf Limited entered into a lease contract for the right to use equipment with a cash cost of 200,000 Rand from Yogi Limited. Both companies have a 31st December year end. The contract is a lease contract as per our IFRS 16 and has an inception date of 1st of Jan 20X3. There are 4 installments of 71,475 Rand paid annually in arrears. We're then given the effective interest rate table based on a discount rate of 16% as follows. And there we see the cash cost being our opening balance. They've worked out our interest. They've used the installments, the 4 equal installments, and we can see the closing balance of 0 at the end of the lease period. You're required to disclose the above in statement of cash flow for the year ended 31st December 20X5 and X4. Okay, so we're going to be using the information from this table, such as the interest of 25,000 and 18,000, to actually impact the operating activities, and the installment of 71,475 to impact our financing activities. And here we see it coming through as an extract from the statement of cash flows, our operating activities being the interest paid directly from our effective interest rate table, and then our financing activities to work out what was the repayment relating to the principal amount. And they've used that saying this is what the repayment is, less what is going to be eaten up by the interest. That then tells us how much is going to be paid towards the principal value of the lease payment. Okay, so that was just a little reminder. We're trying to integrate a number of sections here and expose ourselves to all of the information that we have studied up to this point. Thank you so much for joining me today. If you do have any questions, I'm happy to stay on and help you. Otherwise, this is where we will end for the day, and I'll see you on Friday to go through a very interesting theory-related question on statement of cash flows.